Hello, I'm Chris Pedersen and this is Stock Watch on Wednesday the 29th of May 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few of my market observations. First, economists are mostly bearish. Well, surprise, surprise. They've been bearish for 2.5 years now and there's been no recession, no bear market. Warren Buffett, who I think we all have a lot of respect for, last quarter bought only $2.7 billion worth of shares, I like it only, and sold close to $20 billion. His cash hoard is now $189 billion, up from $169 billion. Well, that is absolutely amazing amount of cash burning a hole in his pocket. However, he's disciplined. He does not buy unless he sees something worthwhile, and he will be patient. Right now, Buffett does not see much value. Buffett doesn't see value, then maybe we should also be very careful in what we buy. Here's the S&P 500 versus the Shiller-Cape ratio since 1871. I'm not going to go into all the details behind this. What is important is that there's 3 times in history when it has been over 30. Now is one of them. And that is a concern because shortly thereafter, the market drops. Growth in private credit. This is just an interesting chart. Private credit is growing leaps and bounds, as you can see. However, like everything, when it gets to be very popular, that's when you should be a little afraid. Utility rates. Well, we know this, that the cost of energy is increasing at one of the highest rates of all of our expenditures. This chart will blow you away. First quarter profit for U.S. companies. The top is Apple Computer. Now these are U.S. dollars. When I convert it to Aussie dollars, that's like $40 billion profit in just the first quarter this year. $40 billion. That is absolutely incredible. Fast food price increases. Well, this is kind of a affordability type thing. Wages is the dark line. Fast food prices is the light green line. As you can see, fast food prices are growing faster, which means to me and many others that inflation is not under control yet. Cars being made in the UK is ticking up. So just by itself, this is not that important. But what it does say is manufacturing is picking up in the UK. It's taken a while. Brexit's been a disaster, but they are starting to recover. Plus, they have inflation under control. So the UK is looking pretty good going forward. Now this is also why they're about to go to an election. Now it looks like the Conservatives are going to get smashed, but maybe not by as big a margin as the polls are saying right now. Here's a chart that I find fascinating. I title it, Why is Inflation a Problem? We know that inflation has spiked up and now it's coming back down. So everybody's patting themselves on the back that inflation's coming down, don't worry. The reality is we look at what we could afford to spend with our money about a year ago, 3 years ago, and we look at what the prices are today. It doesn't matter that it was up at 6% and it's down at 3%. What matters is the prices are like 20% higher than they were 3-4 years ago. That is the cumulative problem that hits us in the pocketbook and why inflation is a problem. So just because the RBA is getting it under control doesn't mean it reduces our cost when we go to the supermarket. 3 companies I want to look at today. The first one is Xero. I looked at this about a year and a half ago, 2 years ago, and it was trading at about $150 a share, and I said short it. Well, the stock then plummeted and was below $100. You can see where it dropped down. It's trending back up. A lot of brokers like it, so I decided to revisit. Last night it was trading, yesterday it was trading at $133.92, up considerably from earlier in the year. Let's look at the numbers though. First, it has a market cap now of $20 billion. Price target by brokers is typically around $155. Some are only at $140, but all the brokers tend to have price targets above where it's currently trading. Revenue growth rate, 2024 to 2026 is 13% per annum. Now I'm looking at 2024 as my starting point because 2023 is a very low figure that would distort the growth numbers. 2023 was a poorer year than 2022. Looking at earnings growth for each of the next 2 years, it's 7% per annum. This is sort of a consensus estimate. And dividend growth, well, it doesn't pay any dividends. So now that the growth rates aren't that exciting, let's look at what the ratios tell us. The PE on the 2025 earnings per share estimate of $1.50, now this is in Aussie dollars, they report in New Zealand dollars, so I had to convert it. It's 88 times PE multiple. That is extraordinarily high. And if you look at the growth rate, is it really worth this high of a PE when it's not growing as it should with this high PE? Well, we know the answer. And it has no yield, so that's okay in a growth stock. Free cash flow is only 2%. Well, that's a concern also. It's a New Zealand company that provides accounting and other small business systems. To me, this company is still way overvalued. Brokers like it. 2027 earnings estimate, give it a PE of 39. Well, 39 is still too much for its current growth rate estimates. I rate it avoid. The second company I wanted to show you is Propel Funeral Partnership. Trades on the ASX under PFP. It's trading at around $5.42. Look at this chart. It's a 5-year chart. Generally, it has a long-term uptrend. These are companies I like that have consistent growth. Sure, when the market goes down overall, most companies decline. But this company didn't decline as much as the market overall did during COVID, and the subsequent recovery has been fantastic. Look at the numbers. Market cap, it's not quite $1 billion yet. It's at $760 million. 12-month price target, I have it around $6.40. Revenue growth rate from 2023 to 2026 is 13% per annum, and the earnings growth in this period is 7% per annum, and the dividend growth matches the earnings growth at 7% also. The PE, however, which is important, the estimate for earnings is 20 cents. This is a 27 times multiple at $5.42. The yield is not that significant. It's 16-cent dividend estimate in 2025. That's a 3% yield. Free cash flow is 3%. And I introduce you to this ratio that's important, PEG. Well, over 1.0 means a company is potentially overvalued. PEG here is 3 times, which, as a reminder, PEG is PE divided by earnings growth rate. The ratio for the payout of dividends is 80%. This doesn't give them a lot of leeway to increase their dividend payout ratio if they need to support the stock price. Second largest funeral business in Australia. It's defensive, not cyclical. Its growth is driven mostly by acquisitions. I don't think it's good value. I rate it neutral. If the price drops significantly, it's not a sell, it's actually a buying opportunity then, because it is a consistent business, and as our population grows and gets older, they will continue to have more business, which is kind of morbid but truthful. Last company is Viking Holdings. This crossed my desk. I liked it. I happen to have a lot of Viking blood in me, so I drilled into it more. It trades on the New York Stock Exchange. It went public about a month ago. It's trading right now at $29.68. Let's look at what the forward numbers are. Now, what's good is this company's been around a long time, so it has historical numbers that people can look at. The revenue growth from 2023 to 2026 is estimated around 13% per annum. The earnings growth is around 20% per annum. They don't pay a dividend. Price target by UBS is $35. The PE on the 2025 earnings estimate of 18 cents is only 9 times. The yield, well, it doesn't pay a dividend. Free cash flow is 6.5%, which is good, and the return on invested capital is 27% versus the sector norm of 10%. It's a luxury cruises for oceans and rivers. Rivers, by the way, is like 60% of its business. It's high-end luxury. It does not have a lot of competition at the high end that these operate in. Does not have this competition which can create pricing pressure, reducing their profit margins. It continues to have room to grow. Because of this potential to grow and high margins, I rate it a buy. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. Hope you have a wonderful week and that it's profitable. Thank you.